Hello, everyone. Welcome to today's session. This is Jesse Webb. Let's get underway. I'm going to start out these presentations in a similar format as have been done in the past. We'll do a brief overview of current market conditions. We'll look at some of the things that are going on in the economy, some different sectors and commodities. And then we're also going to spend some time today. I'm going to spend some time going over a couple of screen strategies, and then we'll go over one individual stock to look at and do just a kind of a deep dive analysis on the report. Pardon me, on the reports page, and we'll see how that looks after, as far as time, after a half hour or so, and we'll try and keep things, I'm going to try and go 30 to 45 minutes on these so we're not taking up all afternoon. And I like to push things through. I'm kind of a hurrier. So I'm going to be very succinct, and we'll get through some of the information relatively quickly, because a lot of this stuff is just really redundant from day to day. Obviously, the long-term signals, the long-term timing signals, they're not going to move a whole lot in a day, and so we're focused primarily on what's happening in general, and then we'll work our way down into this long-term and then into some of the shorter-term examples. That's what's referred to as a top-down approach. A top-down analysis approach is simply looking at the big picture first. It's like looking, the 30,000-foot view. You're looking from your seat in the airline cruising along, and you look down and you look at a shoreline, and that's, you can see an entire country or an entire state, or whatever you can see. You can see the really big picture. That's what this top thing is, and it's very slow moving. As we move down, at least into this shorter term signal, then we're looking a little bit more, we're zooming in. And that's kind of the process that I like to follow. Is first and foremost, what's the market doing? What's the direction of the market? And we obviously know that we've been in this long-term uptrend, starting right here in about April, May. In fact, I've got the date right down here. So April 28th was really when that ticked higher, and we had been bottoming, though. This is April 28th, though. I guess I could have looked right here too. April 28th, but we started this bottoming process in October, November. So now, if we're at the upper end of this range, which I believe we are, at least in the short term, then we will probably see this also start to turn. And that's some of the folks that I want to go over today as well. So our long-term trend, we're obviously in this uptrend. We're at the upper range of that. This, in the last couple of years, traditionally over the years, this time frame has been plenty. But the last few years, with all the volatility, I need to bump this up to like 10 or 12, because that becomes the high end. Even down that bottom range, you can see all the way over here, this was -19. So the extremes are becoming more extreme, but we're definitely, because we've got this number here, I haven't bothered with it, but we've got this is in the upper end, the upper end of this indicator. In the short term, though, we're dealing with some consolidation. We're dealing with an overbought condition where S&P has been rallying, and now we're pulling back. We're meeting some resistance right here, and the shorter term indicators are also saying that. Now this chart right here, this sentiment chart, or this combined chart, is combining sentiment, momentum, and breadth. So it's combining the three indicators that are below it. And sorry, I sometimes make people dizzy by scrolling too quickly, but I just want to explain what these are. These momentum, the orange or red line here is this momentum indicator. And so when we overlap them, we can kind of get a little bit different insight on what's happening as a whole. Are we getting large participation by breadth climbing into a rally? Are we getting momentum? Typically, momentum will lead the rallies and lead the sell-offs. Okay, the orange line, which is momentum. So when we have shorter term market shifts and something is moving back this direction and momentum is leading, that typically is just a shorter term pullback. If we have other factors that are leading, when we start to see breadth participating more aggressively as well, and starting to and potentially leading those moves, that typically means that we're either in the trend or we are something else is taking place. We'll get into this in a lot more detail as we continue on over the courses, but in terms of viewing this, I know it looks like just a jumble right here, but it actually is telling us something, and we'll get deeper and deeper into that. In the meantime, let's just focus on them individually, because we know several things here on momentum. We know that this halfway point can become support and resistance in and of itself. Momentum is now shifted back down kind of below these areas, and that is, we'll see where we end up on today's market activity, but we're working our way back towards this bearish trend. And if we continue to get these bearish trends broken, then this is the early signs of a downtrend. We want to be aware of that. The breadth is also stuck right in the middle, so we're really kind of stuck right in the middle on all of these. Really not in a uptrend or not in a downtrend. We're stuck in a, in a consolidation phase, and that's kind of the current state of the market. So sentiment is still high. We just don't have a lot of fear in the market right now, and that's what we're working with. On the buy-sell ratio is also a great indicator to continue to view your bias. If you're going in and you're trying to decide, hey, I'm going to buy some stocks today, would now be a good time. Typically, you want to wait for this to be green. Okay, we want the majority of the market conditions to be up. Okay, and then we have something that looks like this, something that looks like this. So if you're looking to buy stocks and it's starting to look like this, then you need to hold off. You need to wait. The better opportunity is going to be either at the extremes, when this is really extreme and this is starting to move back this direction, okay, or at a point during that trend. Okay, so maybe there's a series of strong stocks that have new buy signals and you like them and you want to add them to your portfolio, and you've got these type of conditions, red is above green, then go for it. If you're in this condition right here, at least as of now, without a reaction back up and a counter trend and something moving, typically this moves in three parts. Not exactly, but you can see 1, 2, 3, 1, 2, 3, kind of 1, 2, 3 in here that's not clear, 1, 2, 3, and then this one, 1, 2, 3. So typically, and a lot of times that happens in the bullish or in the bearish rotations as well. 1, 2, 3. This is the most common. This last little mess that we've had in the last uptrend has been strange. It's been quite strange. We haven't had the range that we typically do. It's been really tight right here. In terms of analysis, I really don't know what that means quite yet, because I haven't seen it a lot. If I go back a few years, if we go back 3 years, and there's some ranges that have been happening here and here, but towards the upper end and the bottom ends of these trends, then we typically see more extreme. But very simply, the analysis tool is just look to see what's above. Is red above green? I may not want to add aggressively into portfolios currently. I also may want to be considering tightening up my stop losses on winners and exiting losers. Money management, clean out the portfolio scenario. And the sentiment is also moving lower. If you look here on sentiment, the extremes, the value of this indicator is the extremes. Okay, where are we at? Are we at the top end of the range? Are we at the bottom end of the range? Or are we in the middle of that range? So back here, when we're looking at these starting to top out like this, we need to ask ourselves, are we in, and this is based on SPY. So if I were to look at SPY, S&P 500, and look at the chart on this and say, see, so even now today we're selling off, we're ticking back down to the sell side. This is the first one really we've had in a while, and we're right at this support area. So it could be a significant pullback. It could not be. You never know quite exactly as trends develop, but this is an area to say, and that if that holds and stays red, that's going to move this direction alerts over to, right now it's mildly bearish in a bull market. That means that we're in a downtrend in a bull market. We're still in a bull market, a pretty nice one in fact, but we're just pulling back. We're retracing that. So we have mildly bearish. That sell signal is going to take us over to a bearish bias in a bull market. That means wait and see, wait for a pullback, wait for some confirmation. But that sentiment is also, if I go back to that S&P chart and I were looking at this and I were saying, these are hot, these are extreme ranges. Let's mouse over and look at those exact dates right here. So right here, I've got June 5th. This is up here in May 22nd, and then this one right here is July 19th. So June 5th and July 19th. Now let's go back to that SPY chart and let's look at June 5th was back a ways. So we actually, on that upper range, we kind of started topping out here, and then we got some divergence on that July number. Okay, the July number here, what was that? I forgot already. July 18th, 19th, July 18th, 19th. Then we're getting July 18th, 19th. So we had a little bit of extra momentum, but by the time we were starting to top out here, we had that indicator saying, hey, we're at the extreme range. We at least need a pullback to continue more upside. And then we never did get it on that last, and we've been moving lower ever since. So utilizing that sentiment indicator for the edges, for the extremes, and watching to see it, you can see it's pretty consistent. Sometimes it's going to be a little bit early, maybe slightly bit late, but it's going to be very close. And, so managing risk and managing direction and positions is helpful, utilizing that sentiment tool as well. I wanted to talk about building out. So that's kind of where we're at in the market. I did talk in this morning's update. And again, if you're not on YouTube, well, two different things. One is if you go to this Learning Center, click on the Learning Center, and then click on the daily market update right here. So I do a daily market update, and I post it to YouTube as well, and I've just added in this, so you can get that update in that location. And but in that update this morning, I just forgot what I was talking about actually. We were talking about the bond yield curve. So we have this issue with an inverted yield curve. The inverted yield curve, and I won't spend much time on it. You can go back out and watch that update, because this never ends well. An inverted yield curve, and if I go back, this is a 20-year chart. You're going to get different opinions, but in terms of the actual historical value of it, it's very valuable, and it works consistently. It lags. It's a 12-month to 15-month lag. So if you have an inverted yield curve, remember that the stock market is forward-looking. The stock market is looking ahead. So the stock market is not looking at recession quite yet, but the bond yield curve is showing that there probably will be a recession. So this is back in 2000. And I started trading about right here, 97, 98, caught the tail end of that .com boom. My first son was born right here. He just turned August 10th of 2002. He just turned 21, which is crazy. And but this was that sell-off. Now watch that yield curve. We're high, we're inverted. That means that shorter term yields are paying more than longer term yields. That's not the way that it should be working. We should get paid more money the longer we're willing to tie up our money, right? So and in this case, that's just not happening. The desired intent is to slow the economy, which the Fed is controlling that. Ultimately, the bond market is controlling this. I feel like the Fed is ultimately just the puppet of the bond market, and the bond market right now is still in an inverted yield curve. We'll pull that back and look at it. But if you look at this chart up here and look at this as I'm scrolling through it, here's the top inverted yield curve. Here's the bottom of that, but there was a recession in 2001 and 2, but the market was already at the bottom as the recession started, and then the market will climb out of a recession during the recession. So you get the stock market leading into a recession, and then you get the recession, and then you get the stock market coming out of the recession, climbing the wall of worry, so to speak. Everything's going to feel horrendous right here. Stocks are getting pummeled. Economy sucks, and everything feels awful. Well, that's when stock prices start to move. They're climbing out of that because they're not looking at this point. They're looking out here now. They're looking out into the future. So if stocks are going to retrace, and we're sitting at a bond yield curve now at, let me mouse over that one. We're sitting at one of the worst bond yield curves we've had in 20 years, where typically the bond yield curve is the 2 and the 10. Okay, but even here, even the shorter term yields, the 3 months, your savings accounts, your checking accounts are paying more than a 10-year bond. That's not going to last. Okay? And it's designed to break things. It's designed to slow things. And that's ultimately what we don't want to be caught in. Okay, we don't want our assets to be caught in that. We want we want to be positioned in a way that we're participating in that. And again, that's why some diversification in this case makes sense. You know, obviously, if you're making 5% on your cash, that's not a bad investment right now for the next 6, 8, 12 months. Not for everything, but for a bulk of it. If you're in a situation where you need that cash and you don't want to play with it, you don't want volatility, variability, then put a certain allocation into cash and then trading around the rest in individual stocks and different strategies that you may be using. So this is an interesting place, and this, you know, this day today on the SPY, it could be, oops, where did I go? It could be an indication of some weakness that we've got on the horizon. Now, the screens, let's talk about the screens and building out some of those ideas. If you're looking at, let's say that we want to own dividend stocks, and I only want well-performing, uptrending, and profitable companies that are paying a nice dividend. It's a very simple process, and we'll just go through that. It's typical, you know, on the scan, you go, let's say I want $3 or higher. I'm going with stocks, I'm going with US. I want market cap and volume. Let's say I want a little bit higher market cap. Let's go 500 million. The market cap, you know, if you're down in these ranges, you're small cap. 100 million is considered a small cap. Mid cap are going to be between this 250 and a couple billion. Large cap are going to be up in these billions. Mega cap, you know, the Microsoft, Apple, Google, Netflix, those are $100 billion market cap stocks. So if those are the only ones you want, then by all means check it and select it. It actually makes it easy to scan for those kind of names, and you're getting names that you know are going to be around, but you're getting the best of the best when it comes to are they in a current uptrend or not. So let's go volume. Let's say, you know, let's stick with volume on, let's go 100,000 shares. Let's go 200,000. Let's leave the PE at 1. That means it's at least profitable. And let's go dividend yield of 5%. Minimum of 5%. We'll leave the max open. And then let's also set our ROE, some of these fundamental settings. Let's just set them to at least 1. Okay, so it's at least growing EPS. Okay, it's not negative. It's not growing fantastic, but let's start with that. And then let's have stocks that are a buy signal. But in this case, remember that this momentum indicator is if you have, we want an uptrend. So we want this momentum to be between 70 and 140 max. That means we're not going to pull in any stocks that are extreme. And let's bump this number down to 90. And because we want the top performing stocks currently, between 90 and 100, that's going to give us the top performing stocks. Now, if we click on find stocks and we get a goose egg, we get 0. It's too tight of a setting. It's too tight of the parameters. We need to make some adjustments. So let's double check that. Let's click it, and then let's click on find stocks. We got a goose egg. Now, if we go back, okay, let's make a couple of changes here and see if we're getting anything different. There's no stocks that meet that criteria, is my point. Okay, so if we say let's bump this down, let's start with the rank and bump that down to 80. Still nothing. Let's remove the ROE, and let's actually remove all of these and just leave PE ratio and see if we get anything there as well. Okay, so now we've got 4 stocks that we're working with. Okay, let's pull up this top stock here, FRO. So FRO now on a 1-year time frame, transportation industry, transportation shipping. From there, if we want to go out and do a little bit more, pardon me, then more study on the stock, then we can go out to some of these other locations that have got news items and reports and different things like that. For the most part, we're focused on a core set of fundamentals and core price strategy. Outside of that, then you can go out and look for other information because it's all over the place. So in this case, I would say, okay, this is in a buy zone. It's paying a dividend of, in this case, 15% dividend yield. which is really, really high. Okay, but it's also trending higher. So if I'm looking for opportunities in stocks that have high dividend yields, that are growing, this is a $3 billion market cap, so it's not going anywhere, and it's in an uptrend. That's a really fast way for me to participate in and find stocks that I otherwise would have no idea of. How would I know that this stock is doing that? I've got to have a screen of some kind, a scan of some kind, and that's one of the valuable parts of the software tool, is to be able to quickly look for momentum style stocks. It's in an uptrend. I want it to be moving in an uptrend. Okay, in this case, and I also want it to be, fundamentally growing, because that means that the stock, if I'm focused on the dividend, I may be I'm not as concerned with some volatility here. Even this, from 13 to 18, that's a lot of volatility, but I may be okay with some of that if I'm collecting 15% a year on of dividend checks. What I don't want is, I don't want 15% a year and lose 50% of my capital as I'm in that process. So ideally what I want is, I want the best of both worlds. I want an uptrending stock. That way my capital amount, if I had $10,000 here, and I'm able to hold on to that, and typically dividends are paid out each quarter, so and I have to have held it for a certain length of time to qualify for that first dividend check. And if I do that, then I'm able to get capital appreciation. So my 10,000 is now, if I bought it at $15 and it's up $2, okay, I'm up X percent. So my capital is growing and I'm collecting a dividend off it. I'm getting some cash flow off of that investment. Think of it like a rental property. Think of it like, even like your home, kind of reverse. Typically, we have mortgages on our home, so we're paying debt towards that loan, but we're getting capital appreciation. So most of us are okay with, we get appreciation on the asset. So at some point in this dividend paying stock, you're going to be able to sell, and ideally, if you bought it at 15 and sell it at 25 or 30, and you're able to cash out at 20,000 with 10,000 of capital gain, and you're collecting money along the way, you're collecting dividends along the way. That is a passive cash flow generation in process to be able to focus on and to utilize. And it's obviously slow moving, but it's a lower risk strategy. I think that, we're in a world where everybody wants it and they want it now. And you spend time on YouTube, and there's just everybody that's day trading, and there's short-term options, and their futures trading and getting funded an account. And I love that, because I do all of those things as well. But I think for the vast core of most people's investment strategy, it's too aggressive. It's too short term. You got to be really focused and pinpoint on your methodology and strategy. And it's just there's a learning curve as well. So again, I'm not saying don't do that if you're interested in that, because I actually love that kind of trading styles as well. But for the vast majority of bulk portfolio, we want to learn passive income generation methodologies, and building out portfolios that pay dividends is one of the ways to do that. Now, high paying dividend stocks sometimes are risky, because they're trying to attract additional investors, and a high dividend is going to do that. Okay, but they can be volatile. Sometimes they can be garbage too. So that may be a factor. That may be one of the next factors to be like, oh, okay, this negative EPS growth is not thrilling me, and the sales growth is not thrilling me, but the uptrend is still intact. Maybe I go back and look a little bit closer at something different and see if there's anything else in here. Some of these might be, oil royalty type stocks, energy and oil, gas. I don't know, this probably isn't a royalty one, but these oil stocks, energy stocks, they pay out pretty nice dividends, 5-6%. These are annualized dividends. So if you had $10,000, you're gonna get paid $600. Wait, is that right? No, $60 over the course. So it doesn't seem like a lot, but the larger the account, the dividends are being paid out in over time. Dividend strategy for you in terms of the screener, and you can play with that. Okay, you can play with that because we put in some pretty basic numbers. We could say, I want, let's change the momentum, or let's change various things. What I want is I want a stock that is in an uptrend already. It's moving in from lower left to upper right on a stock chart. Yeah, look at my chart. It's going this direction. That's the direction I want to be focused on. And ideally, we have a fundamentally sound company that's growing and moving in the right direction, and we're getting paid on that. That is a portfolio to build out a dividend paying portfolio. Now, let's talk about one stock here. This is the stock I wanted to focus on today, PLX. It's an interesting little biotech stock. It actually had the buy signal on it was 3 days ago, and it's had a pretty deep retracement. Obviously, these biotech stocks are very aggressive, very high volatility and risk. So certainly, it would be a small portion of the portfolio. But let's look at a couple of key features, as I talked about last week, where we're talking about ultimately what, in this case, this is maybe a little deeper retracement than I would have wanted, other than the fact that it has this ability. It has this ability to move pretty quickly, and it's towards the bottom end of the range. The pattern now is up, it's uptrend. It's got a lot of support areas now. This is a pretty traditional bottoming formation here, that upside down head and shoulders, inverted head and shoulders. And now we're getting some momentum to work this direction as well. If we scroll through and look at some of the data points, obviously we're in an uptrend. The trend is advancing. Our rank on this is 96, and you can see the rank had dropped down during some of this selling. It's dropping down, but it's rallying back fast just since July, just from this move. And that part of that is the price of the stock. It's $1.50 and it went to $2. So the percentage move in the last month has been pretty, well, it's not, at least from the last month, where is it from here to there, 11%, maybe a little bit more than that if we spill that over into the prior month there as well. That is moving, that is working. The ROE on it is also moving higher. Now these guys, sometimes with the biotechs, they have different, criteria. I know that these guys, I went out and studied a little bit on it. They have they've got a backing company that is giving them progress funding. So as they hit certain milestones on their FDA approval process, then they are getting additional funding, and that revenue that they get shows up, or the funding that they get shows up as revenue. So it's still a little bit, it's not a pure type of revenue that's coming from customers, although it is their customer. So it still counts, it's still working, and it's still moving in the right direction. So let's look to see, it's the ROE is above 30 typically. And remember what ROE is. ROE is telling us it has high financial efficiency. Management is managing their capital well. And those are really the only three things fundamentally I'm super interested in. Is the earnings per share growth year over year growing? Is the earnings per share quarter over quarter growing? And are the sales growing? And what is management doing with that money? What is management doing with their assets? Okay, you can get a big picture. A lot can be said from just those numbers alone. You could add a million other things, as I've mentioned, but it's just a million other data points, right? For me in this system, in this process of momentum, we want to see momentum. We want to see things that are working continue to work. And as I mentioned in the last session, that a stock price is simply the present value of the future earnings of a company, but it's everyone's perspective of what that looks like. So it's a marketplace. So the stock, ultimately, for a stock to go up, it has to have, the company has to work. The company has to be profitable. It's pointless to expect a garbage company that's losing money to have a good stock price. That happens, but it's only because the market anticipates something different. If the market is wrong and the company keeps dropping, then the stock is going to drop as well. But it's that information that is known or anticipated is always baked into the price of the stock. And in this case, it's the market that is deciding it's the markets that's deciding the overshoots. Okay, so if I were to draw a picture like this, here's the sustainable trend. Here's the sustainable earnings growth of the company. Here's what the market thinks is going to happen. Oh, and then the earnings growth, the earnings report comes out, and yeah, it's good and it's growing, but not what the market expect. Bam, it comes back down. Okay, and it's like continues to grow. It overshoots this direction. Earnings come out. Bam, it comes back down. Okay, it's continuing to move higher, but the market's expectations are wacky. Okay, they're just loony right here because that's what we do as human beings, is we overshoot this direction and sometimes this direction, and ultimately we end up right in this direction. If it's a good company and it's making money and it's profitable and it's growing and management's being efficient with their capital, the stock price is going to go higher, but not without a lot of bumps and bruises along the way. So understanding that, we that's why Buffett, and I've mentioned Buffett before, because he's the wizard in buying companies that are growing. He doesn't care the stock price is going up or down. He's ultimately going to win, and does win, because the company works, whether the stock price is doing the same thing, that up and down motion. So we're going to spend some time on some of these fundamentals, but not everything, because I don't want to know everything. There are lots of different data points of fundamentals. Now, obviously, they're not paying a dividend. Now, the back test functionality on this is then the TradersPro methodology for entry and exit based on that data. So now we've got a data set and some historical one year of history based on the actual signals. So we're saying, okay, these signals are not based on any of these fundamentals. They're only based on price activity. So the reason why is because it's the market that is processing all of the data points, and I would rather participate in with what the market is doing than what the data points are doing. Okay, the data points are just a scanning mechanism, a tool to be able to find a ballpark idea of a quality company, and then from there, the market is going to decide if those numbers are of any value or not. Okay, and they're going to overshoot it. They're going to say, oh man, these guys did this and this and this. What if this next quarter they do this and this and this? It's probably going to be worth this and this and this. And then a retracement comes back and it's like, man, these guys are still growing, continue to the upside. So the market creates this, and then when that doesn't pan out, the market creates that. We get these really nasty ups and downs because we're all a little jumpy out there, right? We're trigger happy. We're buying and selling, and a stock like this is going to be guilty of that. So if this is one that it's like, oh, I don't know if I can stomach that kind of potential volatility, then buy $100 of it, $200 of it, okay? And I'm not saying buy it now, but if you were to make a decision that if that's what you wanted to do, buy a small amount and say, I don't want to stomach this. I'm gonna see what ends up happening, and that allows you to have some a little bit larger idea, at least till you're comfortable. If you're very comfortable, it's like if this is Microsoft and Microsoft looks like this and Microsoft is giving us a new buy signal, or Amazon or AMD or whatever the stock is, then you'd have a little bit more confidence in being able to pull the trigger there. Now, let me explain this extreme, because the extreme on the upside, let me go back to the chart because it doesn't show it on, let me go to PLX. Okay, this is the momentum number 183. Okay, down at the bottom corner here is that momentum. When momentum gets extreme, it doesn't stay there forever. It pulls back and ideally into that buy zone. So when you see a stock that's bounced really hard and it's up in that extreme, this hasn't bounced a ton, but it's a small price stock. So yesterday moved up. That's okay. It doesn't mean it's going to reverse back down. What it means is it may give you a pullback along the way. Okay, something like this or this or this. Some of these down bars that had a big up day, it's going to pull back a little bit. Here was a big up day, it was down, and then ultimately it opened, sold off. So you're going to get some volatility in there. If you're at the upper end of this range, then it just typically doesn't stay there. It can though, and it can really move. In fact, there's two stocks. It was in the new buy list yesterday. Let me see if it actually is in here still. I don't remember the symbol now, dang it. I'll come back to that. But it had a huge momentum day, and it was clear up here in the extreme, and then the next day it went up another 20%. So sometimes it will continue to get rotation A couple questions in here. Let me read this. How much do you worry about the book value? So for me, and the way that this software is built out is, let's say, okay, book value right here. Book value, at least it has a book value. Okay, book value in theory is if I were to liquidate the entire company and just take whatever real assets it actually has on the books, and sell those, then that's the book value. I don't place hardly any value in that, unless, because that's a number that can be manipulated slightly. It's it for for me, I place very little value into it. The only time I place value into it is if you go into the screener and you go to the 21 scans. There's a scan in here that I built out called book value greater than the last price. This one is cool because this one's going to find stocks that have a book value 54 that is higher than the price. And typically, if book value is higher than the price will catch up to it. Okay. So here, this is, if I would have pulled up this scan even a few days ago, this book value would have still been 54. Okay. This doesn't change very quickly. So it bounced here and moved higher. It doesn't always work this way, but sometimes in this scan, book value greater than last, you can find a stock that hasn't moved yet, or it's working on it. Let's see, book value here is 340 and 224. Let's go to that next one. Some of these, book value here is 9 and it's right at 9, so fair value essentially there. And let's see if there's any. A lot of these stocks, a lot of them are going to be the shipping companies, the big oil rigs, the ones that have insurance companies, the ones that have massive assets. Their book value typically is way higher than their price. That's usually the case. Was that the one we just looked at? If not, that's actually a different one, but a utility stock moving. Utilities, that, energy stocks, PBF, they just have tons of assets. 50 and 46. So sometimes you can find some good value in there if you're looking through that scan and looking for the book value, which is less than the price. But in terms of momentum, that's one that I don't include because I'm more interested in the earnings. I'm more interested in the management of those earnings, and I'm more interested in the market's perspective of these data points, of these four: ROE, annual EPS, quarterly EPS, sales growth, and then even dividend if I was interested in that. But in this case, dividend for a momentum stock that has a potential to move up quickly, I'm not interested in that. Neither is the market. Okay, they're interested in momentum. Traders are coming in, take advantage of it, move the stock, and take the money and run, so to speak. Okay. All right, Kirk. Awesome. I'm glad that was helpful. And so yeah, there's a lot of things in here that I feel like it don't get explained, and some, because all of these scans they all have a purpose. If you don't know what they are, go out to the Learning Center here, go down to 21 scans, and click on that, and then click on this download. Let's see if it'll open for me. And this is going to explain what each of those are. Okay, 10% change obviously is the same. ROE is greater than the year change. Return on equity is considered a measure of how effectively management is using the company's assets to create profits. If that is increasing faster than the stock price will typically catch up. So there's that scan. I like that one. ROE is greater than the year change. Quarterly EPS is greater than ROE. The current quarter EPS is greater than the return on equity. Price is market capitalization, the market value of equity per share, while equity is what is shown in the accounts, the balance sheet. So is the EPS growing faster than the return on equity? Also a positive sign. Year change, dividend change, some of those. Here's our book value to last. Book value serves the total value of the company's assets that shareholders would theoretically receive if the company was liquidated. When compared to the company's market value, book value can indicate whether a stock is under or overpriced. The scan looks for the stocks that are trading less than book value, have a current buy signal. That's a fun one to keep an eye on. But that one is not as clean because I don't have a scan that'll give me that exact one, and then I can look for a new buy signal. That may be coming, but it's not in there yet. But it's pretty good as it sits right now. So that's a way for you to look to see what those additional scans are actually doing. It's just in the Learning Center, 21 scans. Click on that, and then click on that download. It's just that little PDF document that opens up. And then back to this stock. So we'll keep an eye. So I want to just to cover the back test, because the back test is how stocks react inside of the TradersPro method. The TradersPro method is, in terms of the buy sell indicators, it is a fixed method. So some stocks are not going to work on it. Some stocks will work very well. The stocks that do work the best are obviously the ones that have high ranks. Okay, these are the ones that are working. These are the ones I'm the most interested in anyway, because these are the stocks that are moving higher. And when they're moving higher, that says a lot. That says more than I could study. For example, if a stock price is moving higher, then the market, and the market is the most efficient beast on the planet. And there are billions and billions and trillions of dollars that are coming in and out of the market all the time. And so everybody that knows something or doesn't know anything is making their decisions by buying the stock. So price activity is going to show everything. Okay, it's going to show if these guys' earnings suck, if their ROE is terrible, if their whatever is, the price is going to show, because you don't think that Ray Dalio and all of his Harvard MBA guys and PhD guys, they're looking at stocks and they're looking at things that I guarantee you they know every little single thing there is to know about a company. And if they've got $50 million that they're looking to buy or sell out of a stock, it's going to show up in the price trend. They move stocks, they move markets. So I'm more interested in price activity with the fundamentals as a scanning mechanism to say, I don't want to, let's say, like Disney, for example. Let's say I want to buy Disney, but Disney is the only thing I know. In fact, let me just pull that in here and see what that looks like. And I may say, Disney is, right now it's a hold. It's in an ugly downtrend. It's got an upside to it in the real short term. But look at its ROE. It's declining continually. Look at its annual EPS. It's declining continually. Look at its earnings per share. It dropped off the table. It's maybe working back up a little bit. So I could say, just because I like the name of Disney and the company, the overall market is saying it's garbage right here. Okay, and even in this case, the signals that the TradersPro provided were not that great, because it's not the kind of stock that I'm looking for. I want to be able to do it on every stock, but I'm only focused on some of these others that have. And that's why I want to teach you some of these scanning mechanisms to be able to utilize that. So you're filtering out all the garbage. And the other thing about Disney, its rank's probably horrendous. Its rank is 42. So it's down at the bottom of the barrel. Okay, we only want the top 90% of stocks. Those are the ones we're primarily interested in and looking for momentum. And if there's fundamental soundness to that stock as well, then that's what we're going to focus on. Any questions or anything before we finish up? I think I'm going to finish up on that note. I'll give you a second to think that over, and let's take a look. See if there's anything else. The other thing too, and next week I'm going to spend some time on this Muscles ETFs tab, because we have a lot of users that are like, I just don't feel comfortable buying one stock or an individual stock. I don't know which one, or I don't want to. I just would rather buy a group of stocks or a basket of stocks. And that's where ETFs are effective, because we track a ton of them in here. It's both long and short, so you get kind of this mixture of everything in here, but it also helps you manage it. It doesn't work as effectively as an individual stock, because momentum buying or momentum trading in stocks is about momentum. It's very about one or two individual stocks catching that momentum. It's very hard to get a ton of momentum in an ETF with a basket of 100 stocks or 500 stocks. It's designed to diversify away the risk, but when you diversify away the risk, you diversify away the reward as well, right? If you own 500 stocks and half of them go up 100%, and then the other half are going down 40, 50%, like your returns of your really good ones are muted by the crap that you have to own in the other 500 in the garbage of the indice. Okay, so ETFs kind of that way too, but they're getting very, very good at creating all these different ETFs that are a little bit more specific, but not quite. Maybe it's a basket of 30 or 40 or 50 stocks. That's better in terms of not diversifying away all of your potential return. And you can manage your risk. That's one of the features in learning is you can manage that risk more effectively by understanding your position size, understanding your stop loss, understanding that it's okay to be wrong, because when you're wrong, you're going to make your first loss your best loss. Make it small. Let your winners continue to work. Once they're working, let them work. Let them work for you until they stop working, and then fire them, right? It's kind of like each of these stocks are your employees, and you gotta manage them. You gotta watch them. You gotta work them. You gotta pick the right ones. You gotta pick the right time for some of these as well. And my internet connection is a little bit slow right now, but that's kind of the way I look at stocks. Is if they don't work for me, then I'm going to get rid of them. And when they're not working, they're going down, or they've hit a stop loss. It doesn't affect me emotionally, personally. I don't beat myself up. I just simply make a change. I just swap it out for something else that is working, and then have a mechanism to be able to learn that swap out system. Which stocks am I looking for and why? What do I want? And ultimately, again, just remember that the foundation of a good stock price is a good company. You can get lots and lots of speculation, lots and lots of trading around different stocks and names, and that's fun sometimes. Sometimes it's not fun, but ultimately the foundation is a good growing company that is increasing its earnings over time. But the markets will reward that company. And you see that with PE ratios, price to earnings ratios, where stocks they're really growing quickly, and the PE ratio goes through the roof. Let me give you a little example, because this sometimes is a fun Netflix is a fun exercise to go through. I don't know if Netflix will be a great example, but it might be. Let's look and see. Let's go back a year. Okay, over on the left-hand side, right here, might be a little hard to see, but this is PE. Okay, that right now that says 34. Let me mouse over it back here. So you see right there, it says 19, 21, 20, 20, 25. The stock is going up, 27, 25, 28, 26, 29, 30, 35, 35, 36, coming back down, 34. What I wanted to see is we've got an earnings report in there, 44, 45, 46. Okay, so that wasn't a great example. Let's look at NVDA. This might be a better example. It might not either, because the PE has been super high on this. 36, 36, 50, 40, 60, 90. Yeah, I'll have to find another example. But sometimes what will happen is this PE ratio, it'll be 40, 50, 60, it'll be moving higher, and then you get an earnings report that's really good, and that price to earnings drops back down again, okay? Like this right here, this was earnings. The PE was at 121 already, 125. The earnings, the PE didn't move much. So it's way overpriced already because it's pure momentum. But if you can find a stock that's increasing and it has an earnings report and the PE goes from 40 back down to 30, but the price is higher, that's what you want. And that's kind of the point of why a lot of people use price to earnings ratio as another filter, or a range. The hard thing about PE is it's typically a range for industries. So you've got to know what the average PE ratio is for that industry. Again, I don't spend much time on that. All I'm looking for in some of these valuation metrics is a scanning filter. I want to find stocks that are inside of certain ranges, but then what I care most about is the momentum that's actually happening. So I want something that's working. I don't want to guess and say, are these guys, is this company, I keep saying a piece of crap. I hope that's not offensive, but but that's what I think of. It's like, I don't want a garbage company. I want something that's working, but then the price activity and the momentum is going to overshoot to the upside. And that's what we want. And sometimes it'll overshoot to the upside by a lot that we can't even imagine sometimes, like Nvidia right here. It was already at the top of the trend, 300, and the earnings shot it up another 60, 80 bucks. That's the kind of momentum type of trading that we want to be able to participate in. I appreciate your time so much today. The recording will be up shortly on YouTube. check that out there. And we will see you, what's today, Tuesday? We'll see you on Thursday. Thanks a lot, everyone. Bye now.